Welcome to this explainer. Today we're unpacking the investor's blueprint for mastering short-term rental financing, drawing straight from expert mortgage advisor insights. If you've ever wondered how real estate moguls seem to just rapidly scale their portfolios without getting totally bogged down by traditional W-2 income verifications, well, you are in exactly the right place. Today, we're breaking down a really powerful financing tool that shifts the spotlight entirely away from your personal paycheck and puts it directly onto the property's earning potential.
Here's a quick look at our agenda for today. We'll be covering the specific advantages of short-term rentals, introducing the DSCR loan, going over the exact qualification rules, and finally, strategizing on purchasing with an LLC. So let's just dive right in.
All right, kicking things off with Section 1, the short-term rental advantage. We really have to start our analysis with a pretty foundational question. Why should an investor even choose this path? Real estate investing is already tough work, right? So why take on the active role of managing short-term guests over just signing a passive long-term lease and forgetting about it? Well, think about it like this. With a long-term rental, your income is totally locked in. It's safe, for sure, but it's completely static. A short-term rental, on the other hand, unlocks dynamic pricing power. You can capitalize on a big local festival, a major holiday weekend, or peak travel seasons to generate significantly more revenue from the exact same piece of real estate. Moving right along to Section 2, introducing the DSCR loan. This specific loan fundamentally changes the game. DSCR stands for Debt Service Coverage Ratio, and instead of agonizing over your personal W-2s, pay stubs, or tax returns, the lender evaluates whether the property's rental income can support the monthly payment all on its own. Basically, if the property pays for itself, your personal income becomes far less relevant to the underwriter. This setup is an absolute lifeline for self-employed individuals who take smart tax deductions, but then get rejected by traditional banks for having a low on-paper income. It's also completely perfect if your conventional debt-to-income ratio is maxed out, you want to buy inside an LLC, or you're looking to refinance after a highly successful Vrbo renovation project. But, here's the catch. You will have to sign a non-owner occupancy certification. That means any extended personal use of the property absolutely needs to be discussed with the lender beforehand. This isn't just some clever loophole to buy a cheap vacation home for your family to hang out in half the year. The lender fully expects this to be a revenue-generating business asset. Period. Let's transition into Section 3, qualification rules and requirements. Let's look at the math. If you remember literally only one thing from this entire explainer regarding your required debt service coverage ratio, make it this magic number right here, 1.00. This is basically the baseline heartbeat of a DSCR loan. To put that into perspective, if your mortgage, taxes, and insurance costs $2,000 a month, and the property's expected rental income is also $2,000 a month, your DSCR is 1.00. Now, while 1.00 means you are breaking exactly even in the eyes of the lender, pushing that ratio up to 1.20 or 1.25 makes for a much stronger file with significantly better options. While some lenders out there might entertain a ratio below 1.00, it almost always means you'll be hit with higher fees, higher rates, or much bigger down payment requirements. Now, because lenders aren't looking closely at your personal income, they have to mitigate their risk elsewhere. You're typically going to need 20 to 25% down and a credit score of at least 640, though obviously hitting over 700 gets you the absolute best rates. Crucially, you need reserves. Lenders usually want to see 6 months of PITCHA, that's principal, interest, taxes, insurance, and HOA fees, just sitting securely in the bank after closing, just in case the property sits empty during a slow season. And even though they don't need those pay stubs we talked about, lenders will still strictly verify your credit, your remaining assets, and your housing history. No tax returns definitely does not mean no underwriting. They want to ensure you actually have a solid track record of paying your bills and the cold hard cash required to close the deal.
Just a quick heads up on this too. A low interest rate might not actually be worth it if you plan to sell or refinance soon because prepayment penalties are incredibly common here. Lenders want to guarantee their yield for a few years, right? So if your strategy involves flipping the house next year, you absolutely must factor the cost of that penalty into your math before you sign on the dotted line.
All right, let's wrap up with Section 4, purchasing with an LLC. This is where it gets really strategic. You can absolutely buy the property using an entity like an LLC or S Corp, but the lender still evaluates your personal background and they will likely require a personal guarantee. This is such a common misconception. People often think buying in an LLC means they totally get off the hook if things go bad. Not quite. The LLC holds the title to protect you from liability, say like a slip and fall lawsuit at your Airbnb, but the bank still needs a human being with a pulse and a credit score to guarantee the debt.
To make this work smoothly, you must follow this sequence in exact order. Have your LLC legally formed before you ever put in an offer. If you sign the contract as John Doe and then try to switch it to your LLC 3 days before closing, you are going to give your title company and your lender a massive headache, and you really risk delaying your entire deal.
Your lender is going to ask for a pretty comprehensive stack of paperwork for that LLC, including your operating agreement and proof that the entity is in good standing with the state. This isn't just about printing a quick piece of paper from LegalZoom. The underwriter needs to see exactly who owns what percentage of the LLC, the official tax ID number, and that state certification confirming the business is actually active.
A really unique requirement here is something called the borrowing resolution. Lenders often require this on their own specific forms, even if your operating agreement already grants you authority. It acts as this official secondary sign-off. It's basically the company formally raising its hand and saying, yes, we totally agree to take on this massive debt, and this specific person is authorized to sign the mortgage on our behalf.
And as for the money, you can use business funds for the down payment as long as you have the authority and can prove the withdrawal won't harm the company's daily operations. You really don't have to scramble to move money back and forth between personal and business accounts, which, by the way, actually causes huge red flags for underwriters trying to source your funds and comply with anti-money laundering rules. If the LLC is footing the bill for the down payment, just document the business withdrawal properly and you're good to go. For the realtors tuning into this explainer, here is your ultimate takeaway. A last-minute change to vesting, which is simply how the buyer holds title to the property, can completely delay or even derail a closing. It is just so much easier to have this conversation up front. Ask your buyer on day one, are you closing in your personal name or an entity? Getting that right immediately sets the entire foundation for a smooth, professional transaction. The real estate market is just full of incredible opportunities if you know exactly how to unlock them. By letting the property's income do the heavy lifting for your qualification, your ability to scale is no longer handcuffed to your W-2. It's really limited only by your ability to go out there and find great cash-flowing properties. So the final question I want to leave you with is this. Are you going to keep slowly saving up your personal paychecks, or are you ready to let your next property buy itself? Thanks so much for joining me for this explainer, and happy investing.